Hey everybody, this is going to be part 6 of my income statement series. And in this video, I'm going to talk about depreciation expense, and we're going to use realty income as an example. So let's just talk a little bit about this company before we break into the financials. So let's just talk about their business model. I'm going to go ahead and read this excerpt. It says, we own over 11,700 properties across 79 different industries, leased to over 1,100 different clients throughout all 50 states, as well as Puerto Rico, the United Kingdom, and Spain, and cash flows generated from our highly diversified real estate portfolio support our increasing monthly dividends and strategic growth initiatives. So long story short, they own a bunch of properties, they lease this out to industry leaders, and they make money. So that's what they do. Now let's go ahead and just take a look at who they're actually leasing to. So we can see this through their Our Portfolio and Portfolio Diversification overview. So right here it says their top 10 industries. So 10% represents grocery stores, 9% represents convenience stores. They have a bunch of dollar stores as well, so 7.7%. They got restaurants, drugstores, home improvement, health and fitness, automotive, and general merchandise. So they're pretty well diversified. Now let's look at their top 20 clients. So we can see right here, Dollar General is 4.2%, Walgreens is 3.9%, 7-Eleven is 3.8%, Dollar Tree is 3.5%, FedEx is 2.8%. Now notice that their heaviest concentration is right around these Dollar Trees and Dollar General. So this is actually a pretty good sign, because if you think about these companies do pretty well during a recession. So right now we're definitely in that scenario where we could end up in a recession. So you always want to pay attention to companies like this and how they diversify. So here we could see something a little bit more risky, like AMC Theaters, Regal Cinema, but these are lower percentages, as you guys can see. Lifetime Fitness, I mean, probably wasn't a good idea to have, Lifetime Fitness during the pandemic, but, you never really know what's going to happen. Notice that they also do have CVS, Walgreens. Let's see what else. They got Home Depot, Kroger. So, diversification is what's most important here. Now let's go ahead and jump right into their financial statements. So this is their most recent Form 10Q. And I'm going to go ahead and look for the income statement. So as usual, we're going to go to the table of contents. Let's see, balance sheets, statement of income and comprehensive income. This is what we want. So let's go ahead and click that. First thing I always want to look at is this right here. We want to read the header. So it says dollars and thousands except per share and share count data. So right here when it says rental revenue is $826 million. And then they have this other revenue of about $11 million. Total revenue is $837 million. Now let's take a look at their expenses. So total expenses says $628.6 million. But depreciation and amortization makes up $419 million. So that is a majority of their expenses. If you watched my last video, you would know that depreciation and amortization are not necessarily cash expenses. So amortization is pretty much the same as depreciation, except it's for intangible assets. So when I'm buying a property, my cash is going to go right out the door as soon as I buy that property. But, on these income statements, they're going to expense the purchase of that property over time. So that is what this depreciation is. So, this is clearly a lot of money. So companies, they will actually do a reconciliation where they'll add this back in. And I'm going to show you that. So we're going to go on page 61. And I'm going to go ahead, scroll down a little bit and read the small excerpt for you. It says right here, the historical accounting convention used for real estate assets requires straight line depreciation of buildings and improvements, which implies that the value of real estate assets diminishes predictably over time. Since real estate values historically rise and fall with market conditions, presentations of operating results for a REIT, which is a real estate income trust, using historical accounting for depreciation could be less informative. So, that being said, they go ahead and they provide us with a reconciliation. So they get the net income available from common stockholders, and this is the first line item. So from this, they go ahead and they add depreciation and amortization. So that $419 million, they add that to the net income. And now look right here, depreciation of furniture, fixtures, and equipment. In my last video, I talked about the difference of depreciation from equipment and from buildings. So equipment actually depreciates over time. So equipment loses value over time. That is usually the case. So here they take that out because they actually consider this an expense. So they decide to take this out, this $511,000. So this is subtracted. Remember, parentheses mean subtraction. Now they have something called provisions for impairment. And let me just talk through this real quick. So they explain this in page 26. All right, so right here it says, certain financial and non-financial assets and liabilities are measured at fair value on a non-recurring basis and are subject to fair value adjustments. So fair value essentially just means, what would the market value this at? So at the time, they had these assets that were worth $48.1 million. And then later they said, hey, you know what? These assets are worth $46.4 million. So that creates this impairment of $1.7 million. Now, over in that reconciliation, they took this out a few more decimal places. So they called it $1.65 million. So here we see some rounding. So let's go back to page 61. So now we see what this $1.65 million is. It's basically a reassessment of some assets. So now we have gain on sale of real estate. So they're not in the business of flipping real estate. They're in the business of leasing and collecting rent. So this doesn't concern primary operations. So they decide to take this out. So they take this out of the net income amount. So after all of this reconciliation, we have something called funds from operation. So this funds from operation, it is $598 million. So this is basically saying, hey, you know what? Our funds from operation is $598 million. And from here, we're going to calculate something called funds from operation per common share for basic and diluted. So they get the total amount of diluted shares outstanding and they divide it by the funds from operation. So the reason why this company doesn't use earnings per share is because earnings per share does not fully represent this company because they are considering these massive expenses called depreciation. And this depreciation is not a cash expense. The cash already went out when we purchased those assets. So it's being expensed over time. So it's an inaccurate representation of the company's actual valuation. So the company, they use this diluted funds from operation and they come up with this funds from operation per common share and diluted. So this is essentially just taking the funds from operation number and dividing it by the shares outstanding. So this is a company that uses a lot of assets to generate their profits. So companies like this, they use funds from operation. They don't use earnings per share. So we're going to go ahead and highlight this. So this is how these companies are valued. This is the metric that you use. So if we're looking at 2021 versus 2022, this company had a higher funds from operations per diluted share. So, they did a better job than they did in 2021 the same quarter. So that's what this is saying. If we're looking at 9 months ended September 30th, well, they have a funds from operation per share of $2.99 versus $2.41. So, this company, they're doing pretty good. And that is how we value these companies. So I hope you guys enjoyed this video, and this is likely going to be the last video of this series. So definitely do check me out on my balance sheet and my cash flow statement series, which I will be having out soon. So I hope you guys enjoyed this video, and Merry Christmas to you all.